want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. Be sure to subscribe to the podcast to get more great investing content. If you're listening on YouTube, hit that like button on this video, and any other platform, your 5-star rating and review are a great way to support the show. Thank you for your support. Today we have a very interesting topic that could be controversial, but I hope will not be controversial. And the underlying thesis for this show is very simple, and we are using our mental model, all else equal. Again, this mental model is the idea that you hold everything constant besides a single variable, and when you can do that, it allows you to make comparisons solely around that variable. And today the variable is, where is a company based? And we're going to specifically compare Japanese companies and American companies with the underlying hypothesis that Japanese companies are worth less than comparable American companies when you hold everything else equal besides the location of the company. So here we're talking about basically you have a Japanese company, an American company, same industry, same returns on capital, similar growth prospects, similar strength of quality business, that sort of thing. So you hold those things similar, you hold their balance sheet similar. And my thesis for the day is that Japanese companies would be comparably worth less than American companies, which leads you to the obvious question, why? So here's my assertions. I believe that Japanese companies are worth less than American companies because culture matters, which requires a big disclaimer. So my understanding of Japanese culture is very limited. Basically, it's limited to my understanding that I can receive through what I observe in the media, what I observe other investors talking about, what I can get from reading information about the culture, history, and many different third-party observations. I don't speak Japanese. I've never visited Japan. And those are very big limitations in this understanding. But there is a lot of talk in investing circles about investing in Japanese companies. And so I've periodically spent time thinking about investing in Japanese companies and what I would do in those circumstances. One of the difficulties is, of course, lack of language. If you don't have the same language as a country, it makes it difficult to fully understand their country and culture. And so if you're unable to read or speak the language, that is certainly a hindrance. But that's not what I'm really concerned about here. It is my understanding, and this is where I definitely, if I am wrong, would tear apart this whole thesis. It's my understanding that in the United States, there's a concept of shareholder primacy. Basically, that the purpose of a business, the primary purpose of a business, is to produce profits and to return those profits to shareholders over time. With the idea being that that same shareholder primacy is not true within Japan. So that's my assertion and my understanding of one of the key differences between Japanese culture and American culture, is that the primary purpose of a company is different. And it's my understanding that in Japanese culture and in Japanese companies, you have a more broad focus on the number of stakeholders by which a company is responsible to. So in the United States, the primary responsibility is to shareholders. But in Japan, it's different. And I'm not 100% sure on this, but from what I can read from various news reports, what I can read from various observations of how companies make changes within their organizations within Japan, and various other investors I respect, that there is a key difference here. And the difference is that Japanese companies are more likely to consider a primary responsibility to be taking care of their employees, taking care of the long-term health of the business above shareholder returns, and that the business is responsible for taking care of their employees, taking care of the environment, taking care of the identity of the founding company. So that's a big difference between Japanese companies and American companies. More American companies are professionally run versus Japanese companies tend to have more founding families that continue to have involvement within the business generation through generation. And it's why you have some companies within Japan that are around thousands of years, because they've been able to sustain themselves for a long period of time. And sometimes that means within the same family throughout that entire time period. That is not something that you see in the United States. You certainly couldn't see something for 1,000 years because the US has only been around for substantially shorter time period. But the key difference is, although many U.S. companies will care about their employees, work hard to take care of them, the primary legal framework, the primary cultural framework in the United States focuses first and foremost on shareholder primacy. And that makes a huge difference for you as an investor. And I think a good example that I want to bring in to back up this statement of mine is Berkshire Hathaway's recent investments into the Japanese marketplace. So Berkshire Hathaway put out a press release on August 30th, 2020, discussing their new investments into 5 leading Japanese trading companies. So they acquired a 5% passive stake in each of 5 companies. And I think this press release is very telling, because Warren Buffett, through this investment as the leader of Berkshire Hathaway, is very cautious in not offending the leaders of these Japanese companies. For instance, in this press release, he says very specific things that are important keywords that a Japanese company leader might be keying into. So I'm going to quote from the press release here a paragraph. And it says, Berkshire Hathaway's intention is to hold its Japanese investments for the long term. Depending on price, Berkshire Hathaway may increase its holdings up to a maximum of 9.9% in any of the 5 investments. However, Warren E. Buffett, CEO of Berkshire Hathaway, has pledged that the company will make purchases only up to an ownership of 9.9% in any of the 5 investments. The company will make no purchases beyond that point unless given specific approval by the investee's board of directors. End quote. So what do we learn here? I think this is very important. You have to understand what's going on. It's not simply that Warren Buffett sees these companies as attractive investments, because he does. He's very cautious in how he's approaching this investment. There's been bad history in the past when Western investors come into the Japanese market and try to take over Japanese companies. It does not go well, and it's incredibly hard to have a hostile takeover of a Japanese company. So Warren Buffett is trying to be very clear, and he's saying, I do not intend to have any takeover of any Japanese company. He's investing because he finds the companies attractive, and he wants to make sure that the board of directors of those companies are not fearful of him coming in and buying their stock. He's very explicit that he puts a maximum amount of stock that he would be willing to purchase. He's not going to purchase at even 10% of their company's stock, because he does not want to intimidate the families or leaders running these companies. And he specifically calls out that he will not take on additional ownership beyond a certain point without explicit approval of those board of directors. He wants to be partners with these companies. He wants to make sure that this is not seen as a hostile takeover, and it's seen very favorably and positively. And so he's being very hesitant. He's stopping just around 5% of shares outstanding, which is an important level in terms of not intimidating the management of these companies, as has happened in the past. And of course, he chose some very big Japanese companies, profitable companies, paying dividends and all those sorts of things. But the key point is that last phrase, that last sentence, which I'm going to repeat again. Quote, "The company will make no purchases beyond that point unless given specific approval by the investee's board of directors." End quote. So this is very important, and it's evidence that supports my idea that the culture in Japan is different than the culture that you may have in the United States. I don't believe this is the sort of press release you would receive if Warren Buffett was making a similar 5% investment in a United States-based company. This is telegraphing his intentions very clearly, when in the US he tries very hard not to telegraph his intentions. And he wants to make sure that he's being upfront and he's willing to have discussions with these board of directors, and he wants to be on a friendly terms with them. So why would that matter so much? Well, some of this is obviously conjecture, but the evidence that I have seen is that within a Japanese company, if business performance does poorly or growth performance does poorly, that the company is not going to be quick and may in fact be very slow or resistant to the idea of laying off employees for any reason along those lines. They're going to do everything they can to retain their employees, to make sure that their employees continue to receive an income and are supported. And there's a lot more of a family atmosphere, that all of the employees in the company are on the same team and they're working together towards success. And it's not as much of an adversarial relationship as you might have with some US-based companies and their employees. But from the investor's point of view, this can be a downside, because it means that instead of cutting costs quickly, like you might see in the United States with mass layoffs as the economy turns south, that's not going to be seen as likely to happen within the Japanese corporate environment. In addition, in the United States, when you see cash build up on a balance sheet, and you see cash build up on the balance sheet in Japan, they're going to be treated very differently. A lot of times in the United States, as cash builds up on the balance sheet, there's going to be an effort to try and return that cash to shareholders in one of a few methods. They might either pay down debt, or they might pay out dividends, or they might buy back shares, or maybe the company will go on an acquisition spree and buy additional companies so that the shareholder value can increase. Some of those actions will certainly be taken from Japanese companies, but the standard operating procedure, the standard culture, seems to be more along the lines of building that cash up for a safe day. As an outsider, it appears like there has been basically scars on the corporations from the massive stock bubble that occurred in Japan in the 1900s. And I think that the companies are still recovering from this idea that you could get so overvalued and have such a long period of time where the stock prices continually drop regardless of business performance. And one natural response to this has been accumulating lots of cash on their balance sheets and being very reticent to have that cash leave the balance sheet in the form of dividends or stock buybacks. So you're seeing a continuously build up. You see very high cash loads on Japanese balance sheets, which lowers the return on equity of those companies, because that cash is now being used as additional working capital to allow the company to function. Even if it's truly excess, it's not necessarily accessible by shareholders. So how would that behave in the United States? Well, if you have a company in the United States that builds up tons of cash on its balance sheet, and let's say it eventually becomes a net, you have activist investors who will come in, buy stock in that company, and work to change the board of directors and get on the board of directors, fire the CEO, and basically take over the company in order to access that cash. It's my understanding that that process, that hostile takeover process, that hostile turnover of the board of directors, simply does not work well in Japan. You would have a revolt from within the company if there was seen as this hostile method to take over the company, because that's not how the culture operates. Now, again, a lot of this is conjecture. I don't have the detailed, intimate understanding within the culture to know that this is true. All I have is news reports from media, whether that be Japanese media in English language, or American media or European media like the BBC, basically world news reports that discusses actions taking place within companies. Anecdotes are very terrible. But like one anecdote I've heard is basically where a company, if they don't have sufficient work, might still continue to pay their employees and have those employees, come to the office, sit in the office, but not do any work, simply because they felt it's an obligation that once they've hired these employees that they should not be fired. This is not exclusive, certainly, to Japan. You see this in the U.S. as well, but it's not common within U.S. corporations. It's more common in stuff that's protected from the forces of competition. I've heard similar stories about teachers within the New York State teaching system. Basically, if you're a bad teacher, the teaching unions are strong enough that it's more expensive to fire a teacher than it is to simply continue paying a teacher not to work. And so you might have these rooms of teachers that are paid to come to work, but not to do any work because they aren't considered a good enough teacher to do so. This is relatively rare, though, in the United States, and I don't have any idea whether it's rare or not in Japan, but I do think that would be a very rare occurrence within U.S. corporations, while it may occur more in a Japanese corporation. This is not exclusive, of course, to Japan. This would be common in many different countries where the power of let's say working unions is high compared to the power of corporations. And another example is France, and I might go into French companies at some point in the future, but that's not for today. So I don't want to spend a lot of time harping on many different of these examples. I think one way that a listener might receive this is to say, okay, well, Trey doesn't understand some of these cultural phenomenons, and so how much does he really have to be able to speak to it? But I think the way that I'm trying to go along is like, the fact that I don't understand is part of the problem with trying to make an investment in a Japanese company. It makes it more likely that Japanese companies are outside of my circle of competence because I don't understand the culture. Because without that cultural backdrop, without that cultural bedrock of understanding where I intimately understand how a Japanese company is going to behave with profits that it gains on its balance sheet, it makes it less likely for me to be comfortable making that investment. So as an American investor, choosing between two equivalent companies, one based in America and one based in Japan, I should favor the American investment because it's closer to my culture and it's more likely to be within my circle of competence. This idea that they're worth less, Japanese companies may be worth less than American companies, is shaded by the fact that I live in the United States, the fact that I am used to and understand the United States culture, and the fact that I don't have that same understanding for Japanese companies. So there's just simply additional risk there as well. But I think it's important to understand and take away from this episode two key things. One or three, 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 three key points. Number one, culture matters. It's easier to understand your own culture and to invest in companies that are based in your own culture than it is to understand and invest in companies that are outside of your culture. And the culture of a nation will drive the behavior of the companies within that nation. So if you want to invest outside of your country, it is very important that you learn some aspects of the culture of the foreign country, because it will drive that country and that nation's and company's performance within that nation. And I have tongue twisters here. Sorry about that. The second piece that I think is really important, and is particularly where I think there's a gap between Japanese companies and American companies, is the idea of shareholder primacy. Now, I'm not saying that the proper, best, moral thing to do is for shareholder primacy to be true. I'm not saying that American companies are better because they have a focus on shareholder primacy, and I'm not saying that Japanese companies are worse because they don't have the same focus. And I'm not saying the American culture is better or that the Japanese culture is worse. What I'm trying to say is that as an investor, you are incentivized to find companies and cultures that put your interests above the interests of other people and other groups. So if shareholder primacy is going to benefit shareholders, which is the people who investors are, then that shareholder primacy becomes an important criterion in your investing process. It provides an extra margin of safety to invest in a country where shareholder primacy is considered important for a company's mission, because it means at the end of the day, the money on the balance sheet is the money of shareholders. And if you grew up in a country where shareholder primacy is taught, you might make the mistaken assumption that shareholder primacy is true everywhere, which it is not. So that's the second key point I wanted to say. Shareholder primacy matters, but it matters specifically for investors. And third, and I think this is one that people might not think about as much, but is a natural corollary to this. Japanese net nets are less reliable than United States-based net nets. So the big problem with net investing is that for a long period of time, good net nets have simply not existed within the United States. A lot of net nets that are still in the United States, usually you have to worry about them being frauds or something very, very wrong with the company. Versus you're likely to find some pretty good companies that are net nets within the Japanese trading exchanges. But just because they are net nets, which means they are trading, their total market price is less than the value of the cash on their balance sheet, does not mean it is as good of a deal to shareholders as a comparable United States net would be. In fact, they are less reliable because you do not have the same takeover mechanisms in place within the country to allow that arbitrage to go away. Within the United States, it's always an option to have a hostile takeover a company to liquidate a net in favor of shareholders. I am not convinced that that is true and possible within Japan. Now, if I have any Japanese listeners that are listening to this and want to correct me, please email me. I'd love to hear from you. I'd love to know where I'm wrong. And I'd love to know what rights shareholders have within Japan and how those rights compare to shareholders within the United States. So that's an area that I'd love to learn, because I do think there are a lot of net nets in Japan. And if I am wrong on this point, it would be very illuminating in giving me potential new investment avenues. So those are my 3 key points. Culture matters, shareholder primacy matters, and Japanese net nets are less reliable than United States-based net nets. I hope this episode has been useful to you. The full show notes for this episode, including my outline for today's podcast, are available at DIYinvesting.org/episode 94. Please remember this is a listener-supported podcast. You can support the show for as little as $1 per show at DIYinvesting.org/patron. Your financial support allows me to continue creating this free investing content without any advertisements. Thank you for listening, and until next time, stop paying fees, start building wealth.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.